Hello, everybody. I'm MAPER's board member, Andy Hood, also a member of the Harrison Township Firemen's Pension System. MAPER's mission continues to educate our members and the investment community during this time of social distancing. We have adjusted our format to provide you with relevant speakers and content these past few weeks through a series of webinars. We regret the cancellation of our spring conference as we understand the importance of networking and personal connections. We are hopeful that we'll return to our typical educational format at the fall conference on Mackinac Island in September. Today, members from the investment team at BlackRock will share their perspectives on the global markets and how this will affect public pensions. A copy of today's presentation can be found on the events page of the MAPER's website. Please submit any questions you have for our panelists using the green Q&A button located in the Zoom app. Questions will be answered at the end of the presentation. Here to introduce our panelists is BlackRock Vice President Andrew Citron. Welcome, Andrew.
Andy, thank you so much for that kind introduction. I too hope to be seeing the MAPER's community up at Mackinac Island here in just a few months. For those of you that I have not met directly, my name is Andrew Citron from BlackRock. I'm from Michigan. My family lives in Grand Rapids to this day, and I lead our MAPER's membership. We understand Michigan has been hit particularly hard. I know firsthand from friends and family by this crisis. So most importantly, on behalf of BlackRock, we wish you and the communities that you serve health and safety during this time. At BlackRock, we are focused on asset management. We're fiduciary to clients. 2/3 of our business is retirement assets, representing the future of billions of citizens across the country. A big part of what we do is building resiliency for those investors. So today we've designed a program that's customized to MAPERs. We're focusing, number one, on thought leadership. Number two, we're going to be introducing a public plan study, a peer analysis of some of your peers across the country. And third, we're going to be sharing leadership from our alternatives team. Our panelists today include Mike Pyle, our Global Chief Investment Strategist, Kelvin Yu and Jonathan Kogan from our Client Insight Unit, and Mark Everett, who is Head of Investment Research for BlackRock Alternatives. We are committed to the MAPER's community, and this session is about you. So I would remind everyone, as Andy said, in the chat function down here at the bottom, I would encourage everyone to submit your questions, and we will get to all of those during the Q&A portion here at the end. Our first panelist today is Mike Pyle, our Global Chief Investment Strategist. Now, Mike spent 5 years at the center of President Obama's economic team. He has experience across a number of crises, including advising the administration during the Eurozone crisis and ongoing sensitivities with China that certainly continue to prevail. Mike, it is not a time for the faint of heart. How are you doing, and what are you seeing out there?
Well, thank you for having me. And the first thing I want to say is to echo some of what you said, Andrew, which is just what a pleasure it is to be with everyone here. I'm from Big Ten country myself. I'm an Illinoisan. I'm not a Michigander, so I spent a lot of my youth watching Illinois get beaten by the Wolverines and the Spartans. But it's just a pleasure to be at home here, really, with other Midwesterners. So thank you for having me. In terms of how we're thinking about the market environment, opportunities, risks, wanted to maybe offer just a few minutes of comments here at the start, and then really open it up to a dynamic Q&A with everyone. Thoughts across those kind of three baskets. How and why have we gotten to where we've gotten, both in terms of the drawdown in risk assets that we saw in February and March, and then the very substantial retracement that we've seen since March 23rd. Where do we see the opportunities out there over both strategic horizons as well as more tactical opportunities? And how do we assess the risks, including, importantly, the one that Andrew flagged around re-emerging US-China tensions? So I'll take each of those in turn for just a couple of minutes each. First, with respect to the very significant retracement we've seen in risk assets since the March 23rd trough. We think that a huge share of what we've seen since then can be attributed to the historic policy response we've seen, especially in the United States on both the fiscal and monetary side to date. Unprecedented programs by the Fed looks to us as if they're going to expand their balance sheet on the order of by $7 trillion over the next 5 or 6 months. That compares to having expanded their balance sheet by $3 trillion across the 5 years post the GFC. So historically scaled in terms of the intervention from the Fed. Similarly, from fiscal policymakers in Washington, we've done $2+ trillion of discretionary fiscal stimulus to date. That is of an order of magnitude more akin to something like a year of the Second World War in terms of share of the economy, and much less akin to the run-of-the-mill recession, or even something like the GFC 12 years ago. So that historic policy response, we think, did a couple of things. One, it took, to a pretty significant degree, the left tail out of the distribution for markets. And that left tail would have been similar to the story we saw 12 years ago. An initial shock propagating into a financial crisis, propagating into a deleveraging event economy-wide, propagating into a multi-year drag on economic activity and growth. We think that the stepping in by policymakers at that time, really headed off that risk and cut that part of the distribution off, allowing markets to get more confidence that while the shock here is historic in magnitude right now, over that multi-year horizon, the amount of output that we'll lose will end up being less. Secondly, there's a mechanical element to this here. The Fed obviously has taken risk-free rates back to the zero lower bound. It's compressed credit spreads by virtue of what it's done. That is, mechanically compressed the discount rate. And when you lower the discount rate, any dollar of future earnings is worth more today. And we think that that dynamic, which has been so powerful across the course of the long expansion, is also playing a role in driving the activity we're seeing in risk assets today. The last point I would make around this is, there's a compositional effect here as well. We've seen a little bit of a reversal in the past couple of days with value and sort of cheaper assets outperforming versus momentum versus growth. But by and large, what we've seen through this crisis is the ongoing outperformance of all of the secular themes that have worked over the past handful of years. Upweighting the United States versus the rest of the world, upweighting quality and growth versus value and cyclicality. Those are things that have worked, and as we've sort of seen the risk retracement that we have, a lot of that is attributable to a U.S. specific, a tech specific, a quality specific story. So that's kind of the first bucket. The second thing around kind of longer term investment themes and shorter term investment themes, we just re-released our capital markets assumptions last week, both in light of the price changes we've seen, as well as our assessment of changing fundamentals. A couple of things that stand out. One, we think the next 5 years is going to be an attractive time for risk assets generally, for long-term investors who can hold those assets in some size. So while that's true across equities and credit, that's true across public and private markets. Indeed, we think that exactly the same forces that led alternatives and private assets to be a very attractive allocation for investors during the long expansion, low rates, scarce growth, scarce income, those are going to continue to be the case looking ahead. One other thing we would flag is, the role of nominal government bonds is more challenged in the coming 5 years than it has been over the past 5. Lower rates, less room versus the effective lower bound to cushion portfolios, potentially more risk of inflation over the medium to long term, eroding some of that value in nominal bonds. We think investors are going to increasingly need to search for alternative forms of hedge assets in strategic portfolios, whether it's something like TIPS, or thinking differently about cash, or thinking differently about the diversification and the resilience of your risk allocations. The third sort of thing that I would want to just say before kind of opening it up to questions is we look ahead around the risks. We see 3 in particular. The first I would say is around policy. As you heard me say earlier, the policy intervention we've seen in the US in particular has been so essential for the market response that we've seen. And I think one of our worries is, as we look ahead over the summer into the fall, that the risks of policy fatigue setting in are quite material. This is what happened 10 to 12 years ago during the GFC, retrenching fiscal policy too early, allowing a sort of ongoing drag from state and local governments, from the federal government to really weigh on the recovery over a multi-year period. We're looking for evidence that policymakers are not going to allow that to happen this time, whether that's continuing to extend in some form enhanced unemployment insurance benefits, whether that's continuing to support small businesses, importantly, given the audience on this call, whether that's finding capacity to support states and localities that are finding their budget squeezed on the revenue side and on the spending side. These are going to be very important fiscal policy questions looking ahead. And the important thing is for us to see that the political will is going to continue to be mustered to deliver support through the duration of this shock, which we expect to persist into the fall and even early next year. The second risk that we would highlight is, again, around these US and China dynamics that Andrew highlighted. We need to look no further than 2019 to know that US-China trade tensions in moments of escalation and moments when they're cascading can have a very significant impact on overall risk appetite in the market. I think one of the things that's worrying now is we are seeing the spread of those tensions away from just the core trade issues and into a whole host of other issues, whether that's things like financial flows and portfolio flows. We've seen issues around the TSP, the federal 401k, whether that's things around the ongoing simmering war on strategic technology around Huawei and other entities. We've seen that around issues relating to Hong Kong and even the virus itself. The point is that the conflict between the US and China is increasingly multifaceted and poses, we think, a growing risk to risk assets as we look ahead across the balance of 2020, in particular in a high political time, both in the United States especially, but also China. The third risk that we would point to, and in some ways, I list this last, though it's, I think, front of mind for all of us, and that is the path of the virus and the epidemic itself. We have certainly seen, especially in East Asia, what a path to some kind of normality can look like, whether it's Taiwan, Korea, China. We have seen this path back on the far side of the acute phase of the epidemic towards normalization of their economies. It's still a slow process. It's still a process whereby the consumption part of the economy is lagging the production side, but it is a path back. And we're going to be looking to see whether or not the US, Europe are able to carve similar paths back to some degree of normalization in the coming period of time. With that, I'm going to go ahead and pause and see if there are any opportunity for questions or back and forth.
Mike, that was great, great background of what's going on out there. We had a few questions that actually came in even before this session. So I'll start with one. You alluded to this a bit with tech and quality, but Martin Timkovich inquired, is it different this time? Is what we've seen in April and May a bear market bounce, or is maybe this just a new bull market?
Yeah, so I think that's a great question. And I think in particular, the past couple of days highlight that in some ways, the most, potentially the most important question right now is not at the index level, whether we're in a new bull market or a bear market or treading water. In some ways, the bigger question sort of sits beneath the hood of the equity market. And it is, are the things that have worked over the past number of years and that have continued to work in the early phases of this crisis, technology, quality, the US versus the rest of the world, are those secular themes going to continue to work, or are we going to see a very pronounced rally in things like value? Value both within individual markets or value on a global basis, EM, Japan, Europe rallying and outperforming. I think we have strong reasons to believe a couple of things. One, on a longer term basis, the next 12 months and beyond, we think there are strong reasons for thinking that those same secular themes that have worked are going to be only accelerated by the COVID crisis and its aftermath. We're certainly seeing, innovations around technology, innovations around the policy response favoring the types of exposures that have worked in the past. That said, the past couple of days have highlighted, over shorter term horizons, over trading horizons, over tactical horizons, that at some level, prices may have become so extreme, both on the long side and the short side around exposures like value, that there can be some significant bounce, especially if the news around the outbreak itself turns more positive. Positive news around a vaccine or treatments or the potential for the economy to normalize, all those things that have been beaten down, airlines, banks, hospitality, can come roaring back exactly as we've seen over the past couple of days. So I think, again, we like those secular themes, but also recognize, as we've seen the past couple of days, over trading horizons, there can be real pockets of vulnerability to those calls.
I think that's really helpful. I want to hit at least one more question that came in before we started, and I would encourage folks to continue submitting questions for the portion that Andy will be leading at the end, dedicated questions during the session. This is one that emailed to us from Stan Ponstein at Kent County. And Mike, you alluded to some of the fiscal stimulus just being incredible. He says, given the recent magnitude of fiscal stimulus and overall US government debt, can we keep this up? And what is the long-term impact potentially for public pensions?
I think that's a great question. I guess I would make a couple of observations. First, I think it's right to note that we are in historic territory with respect to the degree of public indebtedness in the US and elsewhere in the world as a result of the extraordinary actions that are being taken. Second observation would be, regardless of what we're focused on, whether it's the well-being of individuals, households, and businesses, whether it's the well-being of the overall economy, whether it's the overall long-term well-being of the US fiscal posture, I think my assessment and that of many others, I think we heard similar comments from Chairman Powell last week, is, the most important thing is to return to robust growth as quickly as we can, and to solve today's problem today and solve tomorrow's problem tomorrow. And the problem today is an economy that's undergone a historic shock, and we need to return to growth as quickly as public health allows. Fiscal support, sizable fiscal support, allows us to do that. But that then still leaves us likely with a significant set of issues to solve over the longer term once growth has returned. I'd make just 2 points there. Or 3 points. First, I think this does highlight the need for fiscal monetary coordination, as we've seen. The Fed, its balance sheet, its willingness to manage interest rates is going to be an extraordinarily important part of this aftermath, much like it was in the Second World War, much like it was to a somewhat lesser extent during the GFC. We think that degree of coordination between fiscal and monetary policy is essential to managing what comes after this. Second point would be, we do think that this is part of the reason why we talk about there likely being heightened inflation risk over the medium to long term. The immediate shock is likely disinflationary to deflationary, but we think that central banks, as part of managing through this shock, part of managing through the fiscal obligations that have been taken on, is likely to tolerate somewhat greater inflation over the medium to long term. And that sort of highlights the need for a different way of thinking about hedge assets and strategic portfolios, including government bond allocations. That's not a call that inflation is going to run away from us. That's not a call that inflation is even going to manifest itself in a meaningful way, but it is a call that the range of outcomes is higher. The risk profile of these different macro risks is different. And we need to think about asset allocation differently as a result. The last point I would make is I do think that this has implications for taxes moving ahead as well. Whether that's at the federal level or the state level, it's very likely that the tax burdens overall are going to move somewhat higher from here as part of a multi-pronged effort to bring fiscal sustainability over that kind of medium to long-term horizon back into greater balance. I'll pause there.
Mike, that's extremely helpful. And to your point, the complexity of the world today is a bit overwhelming. So the conversation isn't necessarily simple. A lot of these risks are overlapping. I'll hit you with one last question, then let's turn to Kelvin. What is one meaningful risk that you see on the horizon for public pensions that many are not thinking about?
Yeah, I think that's a great question too. And I guess I would just, in some ways zero back in on the first risk that I highlighted, because I think it has a couple of dimensions along which it impacts public pensions. And that would be the risk that we retrench too soon, that we get, that we don't follow through on the policy intervention at the macroeconomic level. I think that matters across multiple dimensions because I think from the investment performance side, that's going to matter. As I said, I think the policy intervention that we've seen has taken the left tail out of the distribution. If those risks begin creeping back into the picture, that's going to hurt risk assets across the board, hurt investment returns. If those risks begin creeping back in, the central bank, the Fed, is going to have to become even more activist, driving rates even lower, bringing things like negative rates onto the table, hurting bond allocations in portfolios even further over that medium to long-term horizon. And lastly, the failure to sort of see through the policy efforts through this shock, I think are going to have very direct sort of implications for state and local finances, putting even greater demands on a shrinking pool of revenue in states and localities not filled in by federal support. And as a result, increasing the demands, or there's going to be increased demands on a smaller pool of revenue, which directly flows through then to risks around the public pension system. So I think, to me, like, all of the risks to public pension space, whether it's on the investment return side or the plan sponsor and contribution side, really come home to roost around this risk that policymakers don't continue to show up and begin to retrench too quickly in the months and quarters ahead.
That was really helpful. Let's now shift to the second panelist. And for folks on the line, Mike will be staying with us, so feel free to submit questions that we can come back to for him. I want to shift to the head of our client insight unit, Kelvin Yu, who will be leading a discussion about this independent study we conducted on the public universe. So I would direct everyone, if you have your slides at home, to slide 4, and I will turn the meeting over to Kelvin.
Thanks, Andrew, and thanks for having me, everyone. So starting on page 4, just to give everyone some background, we conduct a public pension peer risk study every year, and we leverage that data to analyze how the recent market volatility impacted public pensions' assets as well as their funded status. So this analysis is more representative of public plans across the country, and we'll make references along the way on how Michigan plans may differ from the average plan. But for this analysis, we worked with P&I to model 69 public plans, looking at their manager holdings and then mapping it across 35 different asset classes. We then analyzed how the market impacted the assets, the funded status, and the overall asset allocations. So turning to page 6, and based on the manager holdings, we then saw the average asset allocations for the public plans nationally. So you can see cash is roughly a 2% allocation, fixed income roughly 22%, equities 45%, and then alternatives roughly 31%, and it was diversified across private equity, real estate, and private credit. Based on the information we saw from some of the more Michigan-based plans like Ann Arbor, Grand Rapids, generally speaking, what we saw was Michigan plans in general have more in fixed income, roughly around 30% allocation to fixed income. In the equity space, more in equities as well, roughly around 50% allocation to equities, but then less in alternatives, around 20%. And within alternatives, I'd say Michigan plans in general were more focused in real estate, with some allocation to private equity, hedge funds, and natural resources, while the other pension plans we talked about earlier had other things like private credit, private equity, had a higher allocation than infrastructure as well. That being said, we are starting to see some plans like Ann Arbor and other MAPERS plans starting to lean a little bit more into alternatives, and we're seeing some additional allocations planned there. Turning to page 7, we analyze the impact of the recent market stress on the average pension. So we looked at that and also compared a few other scenarios where we looked at the expected volatility of their portfolios. We looked at the year-to-date impact and then also compared it to the Great Recession of 2008 just as a reference point. But focusing in on that recent market volatility column, that down 27%, it was certainly a very significant and fast set of events. And just to give some context of the magnitude, we see on the left-hand side that expected volatility of the portfolio is around 12%. So you can say that this down 27% represents a 2 standard deviation move. But keep in mind that 12% is an annualized volatility measure. So given the fact that this peak to trough period occurred over the course of a month, if you de-annualize it and look at it more on a monthly basis, the expected portfolio vol is more around a 3% kind of a measure. So said another way, in any given month, you would expect portfolios to be up or down 3%. So the fact that we're down 27% in 1 month's time, that represents a 8 standard deviation move. And the probability of that kind of event is effectively 0%. So personally, I find that very fascinating. And so that was the peak to trough period. As Mike alluded to, we've experienced a bit of a recovery since. And so on a year-to-date basis, we see that portfolios are down around 11% up to the end of April. As it relates to some of the Michigan plans, what we think, as we estimate kind of the plans in general, we estimate that the expected volatility of those portfolios to be very close to the average public plan. Even though there was more fixed income allocation, it's offset by more in the equity space. So as a result, we estimate that in general, a lot of the Michigan-based plans might have performed very similarly to the average during these periods. Turning to page 8 and just diving deeper into the data set for the public plans nationally, what we saw was a wide dispersion of results where we saw assets were falling between 20 to 40% on average during this peak to trough period. On the left-hand side, we segmented the cohorts based on funded status. And what we saw was better funded plans saw larger declines in funded status, and that was largely driven from the fact that they have larger asset bases, which are more impacted. On the right-hand side, we compared it against growth allocations, and what we found was the top quartile of asset losses were down 32%, and those plans had roughly an 80% allocation to growth assets, while the bottom quartile of losses were down 24%, and those plans had roughly a 73% allocation to growth assets. And with that, maybe I'd like to pass it over to Jonathan just to go over how this impacted the asset allocations and some recovery scenarios as well.
Hey, thank you, Calvin. So I'll expand on Calvin's illustration of the recent market volatility, and I'll do so by providing a little bit more of some deeper context into looking at some of the historical drawdowns, and then building out a framework for how we may see the recovery take shape and take hold. So I'll turn to page 10, and this really describes the historical drawdown experience of a monthly rebalanced traditional 60-40 portfolio. So 60% in an equity index, the S&P 500, 40% in the U.S. aggregate, a fixed income index, and we look at this historically dating back to the 1970s. When you look at the historical drawdown experience over the last 40 plus years, there were 10 different instances in which the drawdown experience was greater than 7.5%. This generally occurred over an 8-month period of drawdown. The recovery of a recovery period over the following 8-month period, and an average drawdown of about 13%. But if you look at the more recent shocks, and you look at mainly the global financial crisis, and you look at the tech crash in 2001, you saw an increased severity, and you also saw a longer time frame of the actual drawdown and the recovery. So the drawdown was in excess of 20%, and the time frame was more than double that of the average. So it was pretty significant. But today it's different. When you think about the recent shock that we had, the pandemic shock, if you were to add it to this chart, it would actually look a little diluted in comparison to some of those other shocks, because the sharpness of the drawdown was quickly retraced. It happened intra-month, and it was quickly retraced by month end. So the loss would only be about 11.5%, and you'd see a recovery of about 64% in the following month of April. So, a more interesting conclusion is if you look at the year-to-date performance, and instead of assuming that this portfolio was rebalanced monthly, you actually look at it under a different rebalancing scenario. You assume that you allowed your allocations to drift with the market. So what does that mean from a loss perspective, from the drawdown and the recovery? The drawdown would actually be about 17%. So, in reference to the 11.5% of this monthly rebalancing, and the recovery would only be 54%. So that's, obviously significantly different than that 11.5% with the 64% snapback. If you allowed portfolio exposures to drift, you would have seen 550 basis points of greater loss severity and 10% shallower recovery as compared to a portfolio that rebalanced monthly. So we're really going to focus on this concept of rebalancing versus market drifting, and we go into a little bit more detail on page 11. So as Calvin mentioned, the recent drawdown was an 8 standard deviation event. So this is really significant, and it has ramifications in terms of the shifts that actually happen in portfolio exposures. And you can see this on the left-hand side. Most notably that the longer durations outperformance. So you saw fixed income as a little bit of a shift, plus 6% relative to risk assets, which would now be underweight relative to those target exposures of your original portfolio weights. So if you assume that the average portfolio was not rebalanced after the stress event, you would have unintended active risk relative to target, resulting in a tracking error of about 150 basis points. And this can really have significant return implications as markets bounce back and or continue to draw down. And we highlight some of this on the chart on the right-hand side. So just using one example, if you looked at the difference between rebalancing back to original weights or allowing the portfolio to drift with market, you could have seen a difference in return dispersion of 100 basis points in the month of April alone. So the differences between the rebalancing or drifting with the market can cause significant differences in the return that you're seizing over the course of time. We also analyze other effects, so particularly the MSCI ACWI index, looking at different shocks, plus or minus 10%, and we really use this as a tool in order to develop a framework for shaping the recovery that we outline on the following 2 pages. So really starting on page 12, here we are outlining different popular letter-shaped recovery scenarios. So you can see an L, a U, and a V-shaped recovery. But we also show the estimated April year-to-date portfolio performance of the average public plan. And you can see that it clearly illustrates that the markets had a quick rebound ahead of the release of positive economic data, and you would have seen a further recovery in the month of May as well. In terms of the different letter-shaped scenarios, a recent BOA survey, and this was released last month, over half of the respondents expected a U-shaped recovery. So what we'll do on the next slide is we're really going to illustrate the estimated P&L impact of the average plan in these different scenarios that we play out here. So on page 13, what we're essentially showing is the difference between the funded ratios under varied recovery regimes. And it's certainly notable. For instance, if you looked at an L-shaped recovery, so you don't have a real recovery versus a V-shaped recovery where you see this immediate return. The difference in the funded status is 15%, so it's pretty significant. But I think an even more telling point is if you look at the U-shaped recovery and you really look at the differences between rebalancing back to exposures, rebalancing back to original exposures, versus allowing the portfolio to really drift with the market. You can see that the active risk at one point reaches 240 basis points as the portfolio exposures continue to diverge. And this really further underpins the importance of instituting prudent and easily implementable portfolio construction practices, and in some cases may really inform a re-underwriting of strategic asset allocations. So our strategic asset allocation framework really leverages our capital market assumptions. These are the expected returns for each asset class. And even with the repricing of assets at lower valuations due to the pandemic drawdown, our newest capital market assumptions still indicate that only few asset classes have suitable return profiles in order to attain the median assumed return of 7.25%. And these are mainly going to be select regional equity allocations and alternatives such as private equity and private credit and infrastructure equity. So we use these asset class assumptions in order to really imply an expected return for each plan that we analyze in our annual U.S. public pension peer study, of which the analysis that we're going through today is one small component of. We will be releasing the wider study in the coming weeks, and we look forward to sharing that with you as well. I will give you a little bit of a teaser in terms of the initial findings. The initial findings suggest that while 90% of plans, when you look historically over the 10-year realized returns, they were able to exceed their assumed return over that last year over the last 10-year period. But when you look at the forward-looking picture and you look at the expected returns relative to the assumed returns, roughly 75% of the plans are actually expected to fall short of their assumed return by an average of 50 basis points or more, by an average of about 50 basis points. So it's really, let's look at the difference between those that met versus those that met their assumed returns versus those that really exceeded their those that met or exceeded their assumed returns relative to those that fell short. And you can see that the allocation differences are actually quite significant. So for instance, the average allocation to alternatives for those that met or exceeded their assumed return had over 40% allocated to alternative assets. And that compares to those that missed their target returns. They had an allocation to alternatives of just about 28%. And then unpacking that one step further within the alternative asset classes, when you look at the illiquids, the largest dispersions really stem from private equity, which was at 13% for those that met or exceeded assumed returns, which was 6% higher than those that failed to meet assumed returns, and private credit, which was at 5% average allocation, and that was 3% higher than those that missed their assumed returns as well. So as you can see, really contrary to their name, alternatives actually play a mainstream role in public pension portfolios, and I'll allow my colleague Mark Everett to expand upon that in the next section.
Thank you, and good afternoon, everybody. And I have a pretty broad area to cover with you today, and where I come at it from is just the breadth of our footprint here at BlackRock, which is around about $220 billion in alternatives investments, and we're covering private equity, private credit, real assets, real estate, infrastructure, hedge funds. So it's a very broad sort of collection of assets that I'm talking to today. And what I've done is I've tried to split my remarks into 3 sections. And also within each section, a little bit of general commentary and then a little bit of specific commentary. So section 1, I'm going to cover where we are today and how we got here over the last couple of months in the private markets. Section 2, very brief comments on comparison to other crises and the implications for the private markets. And section 3, what opportunities are we seeing in our deal flow today in the private markets? So you can get a sense of look ahead returns for the private markets and how we're thinking about interpreting this landscape, although it is, particularly in private market terms, pretty new. Although I'd say a day in coronavirus time is actually a year long. But anyway, moving on to into section 1. Where did we come from? How did we get here? So, like most other risk assets, I think coming into 2020, private markets were in pretty rude health. That's good corporate health, private credit, private equity, good asset performance, infrastructure, real estate, good strong cash flow and resilience. I think today what we're seeing is a live stress test of the private markets, and it's very significant stress test of private market underwriting because the private markets are now a much larger part of the investment universe than they've ever been. And to give you a sense of that, we would estimate that in 2007, private markets were around about $2.5 trillion. Today, they're around about $8 trillion. So they've roughly tripled in size. And in public market terms, and we've gone from around about 4 to 11%. So there's a lot of investment capital in the private markets, which are significant for 2 reasons. One is, how are private markets going to navigate this crisis with existing capital that's being deployed? The second one is private markets seem to be a very important part of the recovery story here as well. And there will be a need fast, flexible capital. And the scale of private markets means I think it's a significant place to go for that capital. So let's look at that first question about the stress test. When we've deployed assets and invested, as you all know, we just don't have the ability to trade out the next day. So what really will determine the performance of private market assets is the interplay between two forces, right? I think on the left hand, we have what we would call financial resilience. And on the right hand, we have what we'd call investment resilience. And when we talk about financial resilience, I think the impact on revenues, the ability of assets or corporates to undertake cost management, the ability to restructure your business for the COVID and post-COVID environment, and the ability to access liquidity and raise additional capital are all just key to the performance of a private market asset. But what is also significant is something that I think is more influential in the private markets than in the public markets, which is because we don't have that liquidity, we build a lot of safeguards into the investment structure. And I think it's the quality of those safeguards which will determine the actual performance of an asset when you get a hit to the financial resilience, which is just beyond something that you may have modeled at the start of an asset. And those levers are things like entry price, where you are in the capital structure, collateral, protective elements of documentation such as covenants. And each of these levers, I think, plays a significant role in supporting investments through to successful exit. So I think as we see this crisis progress, those two forces, this interaction between them, I think will determine the performance of private market portfolios. Turning to the specific, I think we've seen impact on valuations in Q1. I remember talking about this right at the start of the crisis, in fact, as the equity markets were plummeting. And the big question out there was, what about private market valuations? Where are they going to be 330? Where are they going to be 630? And are they going to catch up with the public markets? I think as we've looked at Q1, I think we would see generally around about -10, -15% in private equity, although different underlying assets are down further, like energy, for example. And there is wide dispersion around those numbers. And low to mid single digits in real estate and private credit. So a repricing that has occurred at 330, and I think the question now is, what does that mean for 630 cash flows? And also, I think there's a new relative question, which is with the effervescence that we've seen in the equity markets. Are the equity markets, out of step with the private markets in an opposite way that people were worried about at the depth of the drawdown? I want to make 4 observations with respect to what we're seeing today in terms of where the private markets are. The first is, I think there's a lot of liquidity activity. Companies, as you know, have been drawing down revolvers, in some cases actually returning cash from revolvers. But the general level of uncertainty out there means that even moderately impacted companies are placing significant value on liquidity, looking to raise buffer liquidity. And a number of companies are approaching us for financing that are stronger, larger, higher quality companies that might not normally look to this channel. There's also private companies looking to create seniority in the capital structure, bring in new investments above existing investments. And that is another theme on the liquidity provision sector. And so the general trend there, I think, is providing liquidity to companies looking for liquidity and going up in quality. The second area that I think we've seen since then is recovery investments. And I think we haven't seen a great deal of recovery investments so far, but there's clearly distressed companies out there, and there's distressed sectors, distressed geographies. I think depending on the duration and the severity of this crisis, we're going to see a lot of what were very good companies facing the question of survival and having to be restructured. And I think in the private markets, we're going to need to make judgments, and we're going to need to make judgments as to who are the winners and losers and what could be potentially significant sectoral change that occurs as a result of this crisis. And it's our belief that it may be worth backing a company and asset, even in a heavy stressed area, if it's likely to be one of the eventual winners in the sector. So understanding the long-term themes at play is going to be critical there. Moving away from the corporate environment and turning to infrastructure, I think there's 2 effects at play here. So I think firstly, transportation assets, they've been hit very hard. The lockdown, the reduction in travel. At one point, I think capacity cuts here in Europe about 90% in air travel. However, a lot of transportation projects have significant liquidity runways. So the question there really is how and when travel returns. And we're starting to see some semblance of that in Asia. I did see some data at the weekend that was showing significant returns in travel post prior crises, but I think this is a crisis different to any other. So we'll see how that plays out. On the other hand, I think within infrastructure, there's a number of investments that are somewhat insulated to these effects. And here I'm talking about things like power, and whether that's traditional power or renewable power. Here you've got long-term consumers of power, which is somewhat not linked to the general level of economic activity. In renewables case, it's really linked to things like wind and solar effects, and also construction and the pricing of electricity. So there's an element of diversification, I think, within infrastructure, while there are, on the other hand, some troubled assets. My final comments on how we got here today on real estate. I think the long-term trend we're already seeing in real estate was the move away from retail and into online. It's clearly being exacerbated. And we're seeing that in collections as they come through. And so we're seeing rental collections in retail probably the lowest of the subsectors. Next would come industrial, which has got some strength from the move to online and distribution. And at the top end of the range, around about the 90% range is commercial property. So there's a mixed bag of collection rates, I think, across real estate, and that dispersion will create opportunity. With respect to comparison to last crises, I'll be very quick here. I think the general perspective is this is a different crisis. It's about health. It's about the economic recovery and the time to economic recovery and how those forces interplay. And I think that will lead to uncertainty and unevenness, whether it's by sector or geographies. And so the lessons that we have to take out of that is, be active in our selection. We also think be diversified. We think opportunities will come about at different times in different spaces. So being flexible in the way in which one thinks about private markets. And of course, maintaining vintage investing. We think not trying to time the markets is important here. And we think staying invested in vintages going forward is important for private market returns. Moving on to opportunities and just wrapping up here on opportunities, I would point out really just a couple of things for you. Deal flow activity is really strong. And we're down about 12% in Q1 on deal opportunities we see across all of these sectors relative to Q4 of 2019. So you would expect us to be down, but we're down, I think, a bit less in terms of the number of opportunities in private markets that one might expect. And if you dig under the hood, we're seeing some really interesting trends here. We're looking at the pre-COVID months, so say January and February of 2020, versus post-COVID months, March and April of 2020. We're seeing a pickup here in the March and April activity. So we're starting to see activity increase. We're seeing it happen in Asia, and that's not surprising as Asia's emerging out of the lockdown. We're also seeing strong trends in deal flow in transportation and in healthcare and technology. Again, sectors that have substantial kind of tailwinds at their back. The types of opportunities, I would just pull out three for you. I think liquidity bridges, I talked about that earlier. I think, modest to decent increases in yield, but really being much better in terms of downside protection there. That's the theme there. For sellers of assets, we think that there will be stress in the investor and the general partner community in private equity, and that will lead to great secondary opportunities for investment there. We're seeing opportunities there around about, loan to value 30%, low teens to 20s IRRs. And finally, acceleration of long-term thematics. And I mentioned that a bit in the deal flow. I think healthcare, technology, renewable power have all got substantial wind at their back now because of the nature of those sectors. And themes that are already starting to emerge are going to be accelerated through this crisis. Above all, though, the mantra here is patience and discipline. What you might see a great deal tomorrow, but are you being paid enough for the risks you're going to take? So we are seeing a lot of opportunities, but I think we're going to be cautious as we deploy into this. That is the end of my prepared remarks, and happy to take questions.
Andy, go ahead and lead us off here.
All right, so let me jump right into questions that we have. I see a few came in from our members. Can you discuss the upcoming presidential election and the potential impact, opportunity in the markets?
How would you like me to take that?
Yeah, why don't you jump in? Mike, you're feeding back though a little bit right now.
How's that? Any better?
That's great, yes.
Okay. So yeah, I certainly think that the presidential election is a very significant risk event. In the back half of the year. I guess I'd make a couple of offer a couple of quick thought. We were at the beginning of the year. It's true in a relative sense, obviously, or that we see out there on the horizon in 2020, but it's also true in an absolute sense about coming into the year, highly divergent policy platforms between potential representatives, the two parties. Obviously, President Trump on the Republican side and some of the more progressive voices on the Democratic side. I think with Vice President Biden being the likely nominee, some of that risk around especially diverse or binary outcomes has reduced. Make sort of two follow-on points that I do think would be previously. One would be, I think, what we've seen President Trump that is taking a much stronger posture versus China. In many ways, Trump is a particularly visible example of a broader sea change in opinion on China at the level of the population as a whole, at the level of bipartisan kind of elite establishment that's sort of nonpartisan versus China, and then we're headed into a much more choppy period of time, lifetime at least, and will be true regardless. Secondly, I do think that this theme around the likelihood of somewhat higher taxes is likely to be accelerated in the event that Vice President Biden wins and there's a Democratic takeover in the Senate. Talked about things about raising the corporate rate back to 28%, reversing some of the Trump tax cuts. I suspect there would also be an effort on individual tax code to take rates back to where they were under President Obama or maybe somewhat higher. So I do think that those two pieces of the puzzle are both in play around the election, one of which I think matters less perhaps than you might think, depending on who wins, and the other could be relatively material in the event we see a Democratic takeover.
Okay, Andrew, I have another question here for Mike, and I'll give it right to him. Mike, can you give us an opinion on the healthcare and technology companies going forward?
Yeah, so I think, I would sort of
Mike, before you jump in, you're feeding back
in some
quite
ways
a bit. I don't know if there's a
what I
way
said
to shift where you are, Mike.
Let me try. Is that any better?
Maybe test it a little bit.
Is this any better?
No, it's not.
I fear I'm speaking. Yeah. And how about now?
Let's give it a go. Hopefully it's maybe something on my end too.
Sure. So I would just quickly.
Yeah, Mike, sorry to cut you off. You're really not even coming through at all. I don't know if there's, it was coming through great at the beginning of your comments earlier, but we can't really hear you at all right now.
You know, basically restating what I said earlier. We think that the secular trends that were in place before this crisis around tech-oriented business models, around businesses that have strong, and let the conversation.
Mike, I'm just going to maybe cut it off there. We will respond in writing with something to that question, and maybe Andy, we can move on to the next question, and hope that Mike's connection improves a bit. Or
Absolutely.
Yeah, I can have it for a minute if you want, Andrew, while Mike's reconnecting.
Sure, absolutely. Go ahead, Mark.
Yeah, I mean, so this won't be as in depth as what Mike is saying, but I think, you know, when we look at those two sectors, right, healthcare and technology, and taking kind of them in reverse, as Mike was saying, that there's a long-term kind of secular, you know, trend at work here, and we're definitely seeing a lot of deal flow in the sort of technology world, and the sort of things I would point out to you is, like, for instance, in private credit, you know, a deal there for you know, a geolocation and advertising company that's looking to acquire someone. So you're seeing weakness in a sector. You're seeing a company saying, I can acquire someone else here, raise some debt. And they're seeing modest upticks in spread, but, you know, again, you know, very much a consolidated play there. And across a lot of the tech space, we think that move, working from home, gaming, cloud, we think cloud is in very early innings. Sort of all of those areas just got rather large tailwinds behind them. In healthcare, I think, you know, interesting statistics. I think something like 20% utilization rate for telemedicine for the crisis, now 60%. So we think that's seeing consumer and regulatory adoption of that process. I think big pharma, you know, is there going to be a move towards more onshoring, and what does that mean for manufacturing of drugs? And I think also in healthcare equipment, PPE production, ventilators, equipment production of all forms, I think seeing positive winds behind the back just because of this, you know, the impact of the crisis. So I'll leave my comments at there, and I know Mike will want to fill in afterwards, but happy to share more as well afterwards if helpful.
Thank you, Mark. That's helpful. And I know that Mike's having some connectivity issues. So maybe we actually stick with you for a moment. I know we're coming up on time. You know, most of the folks on this call that work at public pensions, you know, they're not necessarily built to really time markets and be nimble on a daily basis. Where do you think that BlackRock sees the best opportunities, particularly in alternatives, but perhaps across all asset classes over the next 9 to 12 months?
Yeah, and I think that a couple of observations up front on that. I think that we would note that a lot of post-crisis or crisis investing vintages have done very well. However, we would caution that by saying that we don't believe in sort of vintage market timing in the private market. So our encouragement to people is, you know, spread your risk across a number of vintages. And we think when you look back at your average return over a long-term time horizon, you'll be adequately rewarded. The second thing I would say is that in terms of exit, like when we're thinking about investing today, we're thinking about exits that are 5, 10, 15 years in the future. So we're looking through this crisis and actually into different kind of conditions. Hence my discussion earlier about putting safeguards around investments. So all of that to say that I think that this question of identifying an opportunity is just very difficult in a private market sense. And we'd encourage flexible mandates and diversified spread of timing across vintages. Having said that, areas that we find interesting at the moment, I think fit into kind of the long-term trends. So what we talked about in investing in healthcare, technology, we like doing that through the credit world. I think in secondaries, we expect, particularly if there's another sell-off in the equity markets, we'd expect to see denominator effect causing more stress in private equity secondaries. And as I mentioned to you, I think you can get returns there, high teens sort of returns from either, buying a secondary portfolio, so a mature portfolio from another LP investor, or coming in as the preferred capital into a general partner that's looking to raise additional capital and sitting on top of all the existing capital that's in there. So a very well protected sort of loan to value, 30% type of risk there. And the final area is the area that's probably the most important of all, which I think is the focus on sustainability and ESG in general. And I think renewables there, I think 2/3 of the world's power produced by regular forms of power. And I think the International Energy Agency by 2050 predicts 2/3 being produced by renewables. So a massive demand, I think, for renewables. They're often the cheapest electricity into the grid, so they're the first electricity consumption. And we think tremendous growth there. And within that, particularly tremendous growth within Asia. So those are the three areas I might investigate further in the context of my opening comments.
Well, thank you, everybody. As we're getting towards the end of our time here, we did have some extra questions that came in. Didn't have time to answer. So if you could please just email those to the MAPERS office. We will get them out to the panelists here and get your answers back to you. Please watch our website and your email for updates on the status of the fall conference. We would like to continue to offer educational webinars to our members over the summer months. Please forward topic suggestions to our office. On behalf of the MAPERS board, we wish you, your family, and your colleagues good health and safety. Thank you.